Welcome to my video about the valuation of stock using the dividend discount model. My name is Dennis Vink and I'm a Dutch professor in finance. In this video, I'm only going to talk about the learning objectives. I have 5 separate videos on the topic. The first one being about the dividend discount model, but then without any growth opportunities. In number 2, we're going to have a look at the DDM model, but then with growth opportunities. And in number 3, we're going to have a video about changing growth rates and having a look at the impact on the stock price of the firm. And in number 4, we're going to look at a company that's going to, for example, buy back shares and see how the stock value is going to change in the market. And in number 5, I have a separate video that is exclusively dealing with a summary on the dividend discount model. So we have 8 learning objectives. The first one is that you should be able to describe in words the law of one price to value a common stock using the underlying cash flow, which is the dividend that goes to the investor, and the discount rate that should be used. Number 2 is that you should be able to calculate the total return of a stock. And the total return of a stock can be broken down into the dividend payment and the capital gain, which is related to the current price and the previous price. With learning objective number 3, we're going to apply the dividend discount model, but now with changing growth rates. So we're going to have a look at how the dividend will change in time and see the impact on the stock price. With number 4, we're going to have a look at the drivers of future dividends and growth rates. And we're going to have a look at the impact on the underlying stock price if we're going to change the size of dividends and, for example, the size of the growth rates or a combination of both. Learning objective number 5 actually enables you to calculate the growth rates of dividends using the retention rate and the return on new investments. For number 6, we're going to describe the circumstances in which cutting the firm's dividend will actually raise the stock price. Number 7 is about the dividend discount model. But here we have 2 periods in which we have different kinds of growth rates. And here we're going to apply the terminal value to calculate the present value of a stream of dividend payments with a constant growth rate after a specific period in time. In the last learning objective, we're going to compute the stock price of a firm that pays dividends as well as buying back shares. Now please open the next video that is called the dividend discount model. Thank you.